The Fed shall continue to increase interest rates if inflation exceeds 6%, unless unemployment hits 5%, which is historically where the Fed chairs always make their U-turn on interest rates. As the chances of a recession have lowered to 35%, here is how much the Fed will raise interest rates in 2023. Let us get started. According to multiple sources, the Fed will miss its target to bring inflation to 5.5% in 2023. This means that Fed Chair Jerome Powell would have failed, and the interest rates would continue to go higher. We will not get into the politics of whether Powell will resign, but the important issue is to discuss its impact on the people after a year-long inflation crisis. By estimation, the Feds will push 50-point increases, 2 of them at the start of the year in 2023 to try to cut the inflation in half. As of October 2022, the annual inflation rate was 7.7%, the lowest since January 2022, and below the 8% projection. This is the 4th month inflation has reduced, although Americans have yet to feel the proper ease in their monetary activities. Wall Street is adamant about striking out interest rates for next year because the projections show Fed targets may not be met. Soon, we will bring bits of Financial Post covered by the top dogs of financial investment companies. Analysts are certain that lender rates will hit 5% next year, and other borrowing systems like mortgages could go higher. At the start of November, the Fed chair indicated that incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. This means that they are convinced with what they did in October and intend to keep it up, moving into the next announcement in December. The Financial Post shared some insights from various Wall Street giants and their projections as the next statement comes early next month. According to them, Bloomberg economists are convinced we will enter another inflation bubble next year. Anna Wong, chief U.S. economist at Bloomberg, said, Chair Powell has been pretty clear in his communications that the committee has learned one key lesson of the 70s, which is not to loosen rates prematurely even in the midst of a recession. The most compelling reason for Fed to cut rates in 2023 is if inflation falls below 3%. That's not our modal forecast. Indeed, our inflation forecast sees the 68% chance of inflation between 3% and 5% next year. However, one of the primary resolutions that the Fed is known to maintain is that it does not want to see people lose their jobs. In the past, once the Feds realized that jobs were on the line, they made U-turns with interest rate cuts. Will the Fed have the courage to act? Later, we will tell you what historic instances make us believe they will. Deutsche Bank, the first to predict a recession, says a U-turn in the face of a contradiction in which unemployment hits 5.5% and inflation falls slightly over 3% is realistic. Goldman Sachs economist Jan Hatzius said the Fed would not lift immediately. According to Jan, too much easing too soon could interfere with the Fed's efforts to keep growth below potential until inflation is clearly on its way back to target. Again, Piper Sandler's report, authorized by Roberto Perli and Benson Durham, declared, this cycle started in March of this year, only 8 months ago. Most likely, it won't be much sooner than March 2023 that the Fed can have a good idea of whether the recent tightening has been enough to curb inflation. Stay with us to find out if March 2023 brings any hope. We will be the first to update this news when it happens. Financial Post gave examples of this. For instance, in 1984, Chair Paul Volcker rescinded his decision in 6 weeks, cutting back rates by over 500 basis points to avoid a complete unemployment crisis. Further, in 1989, Chair Alan Greenspan kept the high rates for only 3 weeks, as he went ahead to reduce by 700 basis points. Therefore, some Wall Street experts like UBS, with projections of unemployment crossing 5% by 2024, are confident that the 2023 high rates will last for a while. It must be noted that the problem we face currently is more people refusing to work than having no jobs. Forbes contributor Bill Connerly connects the dots in finance and has accused the Federal Reserve of bringing this upon themselves. In his article on the subject, Bill says that a mistake has led us here. He connected the Trump COVID relief and Biden stimulus checks as the leading factors of our economic situation. The Federal Reserve provided funds for effective stimulus programs under both Trump and Biden administrations. These acts during the pandemic have been described as a mistake. However, based on the 2008 to 2009 Fed chair Ben Bernanke's memoir, The Courage to Act, which is about how he handled the recession of the period, might not have been an alien crisis program to support. However, experts blame more of this on the Fed's interference during tough times. We cannot say we were unhappy about receiving stimulus checks, but it makes sense that once we receive those extra thousands, we push demand in used cars and housing off the charts. The Federal Reserve has acknowledged that those actions have brought the economy down on one knee. However, with a new inflation target and early 2023 rate increases, Wall Street is forecasting a 35% chance of a recession as opposed to 65% in June. If you are trying to figure out where to keep your money to hedge against inflation, we have a video that carefully details exchange-traded funds for beginners. It could be your best option as interest rates continue to rise next year.